The Institute for Financial Literacy is a collaboration between MoneySense, the National Financial Education Program, and Singapore Polytechnic International. The Institute is the outreach arm of MoneySense. We conduct free and unbiased financial education programs for the public. MoneySense is Singapore's national financial education program set up in 2003 and is currently overseen by MAS, Monetary Authority of Singapore, and MOM, Ministry of Manpower. MoneySense aims to help Singaporeans manage their money well and make sound financial decisions on their own. Understanding Real Estate Investment Trusts, REITs. This is the first in a series of 2 videos on understanding real estate investment trusts, or REITs for short. In this video, we will look at what REITs are and how they are structured. What is a REIT? A REIT is a fund that invests in a portfolio of income-generating real estate assets such as shopping malls, office buildings and warehouses that are rented out to tenants. Assets of REITs are professionally managed, and revenues generated from those assets, which is mainly rental income, are normally distributed at regular intervals to investors. REITs allow investors to access real property assets and share the benefits and risks of owning a portfolio of properties. REIT investment restrictions. REITs listed on the Singapore Exchange, SGX, are sometimes known as S-REITs. They are regulated by the Monetary Authority of Singapore, or MAS. Among the investment regulations they have to observe are the following. At least 75% of assets owned by the REIT must be income-producing. They cannot invest in vacant land and mortgages, except for mortgage-backed securities. They can undertake property development of up to 10% of the total value of property held in their books. Maximum property development allowed is 25%, provided unit holder approval is obtained, and if the additional 15% is for redeveloping an existing property that the REIT has owned for at least 3 years and will continue to hold for at least 3 years after redevelopment. REITs versus business trusts. Investors should be aware that business trusts, which are business enterprises structured as trusts and not companies, can also own property assets and collect rental income. However, there are important differences between REITs and business trusts. Among them are trustee and manager. For REITs, the trustee of the assets and the manager have to be separate entities, while for business trusts, they are the same entity. Governance. REITs are governed by the Securities and Futures Act, while business trusts are governed by the Business Trusts Act. Dividends. To qualify for tax exemption, REITs have to distribute at least 90% of their income as dividends. Business trusts, on the other hand, are not obliged to pay regular dividends. Gearing limit. REITs are subject to a borrowing or gearing limit. This was raised from 45% of total assets to 50% during the COVID-19 pandemic. Here are some examples of REITs and business trusts listed on SGX. Here is where REITs rank in terms of risk and return compared to other assets. They are considered to be moderately risky investments that can be expected to deliver moderate returns. Here are some examples of properties that are typically owned by REITs. Hotels and service departments, warehouses and industrial buildings, commercial buildings and shopping malls. There are different categories of REITs listed on SGX. These are some examples of those that operate in the healthcare, retail, office and data center sectors. Earnings growth strategy. How do REITs grow their earnings? 1. Accretive acquisition. This is probably the quickest means to growing earnings, though acquisitions have to be yield accretive. This means that the rental income should exceed the cost of debt and equity used to fund the purchase. 2. Rebalancing. In addition to buying new properties, the REIT could at the same time sell underperforming property. 3. Rental increase. This is the most obvious way to boost earnings, but it is important to take into account the state of the rental market at the time the increase is being considered. Increasing rents may force tenants to move out, while raising rents too often could damage the REIT manager's reputation. 4. Asset enhancement. This means changing the tenant mix and maybe attracting luxury tenants or a prominent anchor tenant to optimize space usage. Structure of REITs. We will now take a look at how REITs are structured. The trustee. REITs are structured as trusts, and thus the assets are held by an independent REIT trustee on behalf of unit holders. The trustee's duties are laid out in the trust deed, and these duties typically include ensuring compliance with all applicable laws, taking custody of the real estate assets, and protecting the rights of unit holders. The REIT manager and property manager. The real estate properties in the REIT are managed by a property manager, while the REIT itself is managed by a REIT manager. The responsibility of the REIT manager is to set and execute the REIT's strategies. The manager is usually a 100% owned subsidiary of the sponsor and is paid a fee for managing the REIT. The responsibilities of the property manager are to maintain the properties, to achieve the best tenancy mix and rental income, and to run marketing events to attract shoppers or tenants. Like the REIT manager, the property manager is in many cases a subsidiary of the sponsor. The sponsor. A REIT sponsor is usually a large real estate company with investment in the REIT. In the case of sponsor-backed REITs, the sponsor provides support by injecting its own properties into the initial portfolio of the REIT upon listing. Next, we will talk about the roles of the various parties in a REIT in greater detail. The REIT trustee must be separate from the REIT manager. Is also responsible for the ownership and safe custody of assets. Acts on behalf of unit holders who are the beneficiaries of the trust to ensure the manager performs according to duties in the trust deed. Earns a fee based on property value. For example, when buying or selling assets from and to interested parties, the trustee has to ensure the manager appoints at least 2 independent valuers. The REIT sponsor. The role of the REIT sponsor is not spelt out by MAS, but depends on the relationship between the trust and the sponsor. As noted earlier, sponsors are usually big property developers. If they are well known, this is an advantage as it means greater credibility. This can help the REIT secure beneficial financing terms. Strong sponsors can also provide a regular pipeline of cash flow generating properties to the REIT. But the sponsor and the REIT are related parties, so there's potential for conflict of interest. The REIT manager is usually a subsidiary of the sponsor, has its own board of directors and CEO, and sets the REIT's strategic direction. Must act in the best interests of unit holders. Provides investment recommendations to the trustee on buying, selling and enhancements. Appoints the property manager. Earns a fee like a portfolio manager, usually a base fee plus bonus if performance exceeds expectations. Is the brains behind the REIT. The REIT's property manager is sometimes a subsidiary of the sponsor, collects rent, designs marketing and promotional programs, helps the manager ensure best possible tenant mix, is usually paid a fee based on gross revenue and net property income. Here are the key takeaways. REITs own and rent out properties such as retail malls, office buildings and warehouses. They collect rental income and distribute the funds to unit holders. REITs that distribute at least 90% of taxable income qualify for tax exemption. REITs are set up and governed by a trust deed that segregates the duties of the trustee and the REIT manager. REITs can grow their earnings by buying new assets and selling those that are non-performing, or by raising rents or by asset enhancements.